Welcome to this explainer. Today we're stepping into the shoes of an expert investment analyst to put Enterprise Products Partners, ticker EPD, through the absolute ultimate valuation gauntlet. We're going to take a massive amount of financial data from our sources and run this company through the legendary investing frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, before stress testing it all with a modern discounted cash flow model.
But hey, before we even start the gauntlet, you've got to consider this totally staggering hook. EPD is currently offering a massive 6.01% dividend yield, and it's backed by an incredibly rare 27 years of consecutive annual dividend increases. Seriously, that immediately begs the question for any analyst. Is this midstream heavyweight a hidden gem for income investors, or just a classic yield trap masking some underlying weakness? Let's find out.
All right, here's our roadmap. We'll start with a quick company snapshot, then apply the Buffett, Lynch, and Graham lenses. After that, we'll run a modern DCF valuation and bring the whole shebang together for a final recommendation.
Section 1. The company snapshot and baseline metrics.
So Enterprise Products Partners LP is a leading North American provider of midstream energy services, and they are firmly committed to returning capital to unit holders. Actually, they're actively repurchasing $275 million in units so far in 2026. They're also navigating a really smooth management transition right now. AJ Jim Teague is planning to retire in 2027, which leaves co-CEO Randy Fowler taking the sole helm. That provides the kind of steady, honest management continuity that long-term investors absolutely love.
The crucial point to grasp here is their massive infrastructure scale. We're talking over 50,000 miles of pipelines and 300 million barrels of liquid storage. Essentially, they effectively operate the toll roads connecting the producers and consumers of natural gas, crude oil, and petrochemicals. Think of it this way. They don't drill for oil themselves, they just charge a fee to move it around.
Let's lay out the baseline data from the market. At a current price of $37.27, we're looking at an $80.63 billion market cap behemoth. It's trading at a moderate price-to-earnings, or PE, multiple of 13.80. So that gives us our baseline to really begin the gauntlet.
Section 2. The Warren Buffett lens, quality and moat.
For Buffett, it all starts with the moat, and a true economic moat in the pipeline sector is incredibly strong. EPD's fee-based cash flows are heavily protected by immense capital costs, environmental regulations, and some really strict permitting hurdles required just to build competing pipelines. It's basically a classic toll road monopoly in a lot of the regions where it operates.
Let's look at how EPD actually performs on Buffett's quantitative checklist. Well, it absolutely crushes the return on equity test at nearly 20%, showing excellent capital efficiency. The debt-to-equity ratio sits at 1.17, which is highly manageable for an infrastructure company with such predictable cash flows. Earnings, incredibly consistent, with trailing 12-month net income at $5.89 billion. And for Buffett's all-important owner earnings, we can look at their free cash flow, which sits at a robust $2.20 billion. So yeah, EPD definitively meets Buffett's quality criteria.
Driven by this moat and expected Permian export growth, our narrative analysis estimates a Buffett-style intrinsic value right around $41.25. Given the current price of $37.27, this indicates it passes his quality test and actually offers a modest margin of safety of about 10%, meaning Buffett would very likely be a buyer here.
Section 3. The Peter Lynch lens, growth at a reasonable price.
Lynch always categorized companies first, so we really have to ask, where exactly does a massive, dividend-paying infrastructure partnership fit into his universe? I mean, is it a fast grower, a cyclical, an asset play? Looking at the data, EPD sits firmly in the stalwart or slow growers category. While their 5-year revenue compound annual growth rate is a solid 12.3%, their trailing 12-month revenue has actually contracted by about 9%. But hey, you don't buy a stalwart for hypergrowth, right? You prize it primarily for stability and dividend protection during economic downturns.
Next up, we calculate Lynch's favorite metric, the PEG ratio, which divides PE by the growth rate. EPD's PEG ratio sits at 1.49. Now, anything under 1.5 is generally considered reasonable for a stalwart. Assessing the balance sheet, the current ratio is 0.91. While that's slightly under 1, it's entirely normal for midstream operators who distribute cash aggressively rather than just hoarding it. Now, our sources do omit exact figures on insider buying and institutional ownership, so to fill this gap, we just have to assume standard industry averages. Ultimately, blending that 1.49 peg with that sweet 6% dividend gives this a solid Lynch-style hold or maybe a cautious buy specifically for yield-seeking portfolios.
Section 4. The Benjamin Graham Lens, Deep Value and Safety.
Okay, running through the defensive investor checklist point by point. Adequate size? At $80 billion, that is a massive pass. Earning stability? Pass. Continuous dividend record? 27 years makes that an easy pass. Moderate PE below 15? Yes, at 13.80, it passes. However, Graham prefers a price-to-book ratio under 1.5. At 2.76, EPD is borderline, which really just reflects the premium the market places on its highly profitable assets.
But the real make-or-break test here is Graham's famous intrinsic value formula, the square root of 22.5 multiplied by earnings per share multiplied by book value per share. This formula is strict. It demands absolute historical earnings and tangible asset backing for every single unit.
Using the historical EPS and book value data from our sources to solve the formula, it yields a strict Graham intrinsic value of just $28.42. So, to a strict value investor, there is actually a negative margin of safety at the current $37 price. Graham would likely not touch this stock until it dropped down into the high 20s.
Section 5. DCF and Alternative Valuations, Modern Projections.
Building our base case DCF, we start with the trailing free cash flow of $2.2 billion. Assuming a standard midstream weighted average cost of capital, or WACC, of 8 to 9% and a conservative perpetual terminal growth rate, our model generates a massive fair value of $62.49 per share. And of course, running a sensitivity table on these rates shows that even slight increases in the cost of capital keep the value well above the current price.
The divide here is just massive. The DCF calculates a fair value of $62.49, which offers a huge 67.67% margin of safety compared to the current price. If we apply at least 2 additional valuation models from our sources, specifically looking at comparables, EPD trades at an EV to EBITDA multiple of just 11.66 and a PE of 13.80. Both of these alternative multiples suggest a fair value range comfortably in the low to mid-40s. That strongly supports the bullish DCF and Buffett targets over Graham's highly conservative math.
Section 6. Synthesis and Final Verdict, Blending the Insights.
You know, you always have to carefully weigh an investment's profile. The key strengths here are undeniable: a toll road economic moat, a massive 27-year dividend growth streak, an excellent return on equity. But we have to balance this against the genuine risks outlined in our sources: unexpected operational setbacks like PDH plant outages, shifting global energy regulations, and the reality of negative recent trailing free cash flow growth.
So what does this all mean? What's our final verdict? Looking at our summary table of all fair values, EPD is a definitive buy under Buffett's quality metrics at $41 and highly undervalued by modern DCF models pointing to $62. It's a solid hold for Peter Lynch fans. However, it's a clear pass for Graham Pittras waiting for a drop below $28. Ultimately, the market is pricing EPD as a highly stable income compounder, not a value trap. The real question is, which investing legend's philosophy aligns with your portfolio?